Today I will be covering a few points on the new rules on subsidies. Let's talk about that, because once you start making the 6 figures, you need to know how to save it from the taxman to keep more out of what you make. So basically, you need to be able to do the best to keep a lot of your earnings in your pockets. I'm going to give you a few information about what is new, and we can talk later and you can ask questions. The first one is just briefly covering what we have on the new subsidies. A lot of people are still unemployed or were unemployed, lost their jobs last year. Because of that, there are some benefits that the government provided. But it used to be the emergency recovery benefits, but now is the Canada recovery benefits only, which changed from September of 2020 and will go until 2021 September. Basically what that does now is, if you are not working because of COVID related issues, there are so many things you can do, so many ways you can qualify for that. So when you get the money, they will already take 10% off towards your taxes. But for those who received the CERB last year or received some of the CRB, you will get a T4A from the government that will specify how much you collected from them. So that would be good, because it helps you. With the CERB, it did not have anything removed as tax, but the government became wiser later and started deducting the 10%. So basically with that, you already have an edge, because they've taken 10%, you wouldn't have to pay much more. But don't forget that the CERB was limited to 14,000. So if that was all you got from them that time, between March and September middle, before the CRB started, then you will have to, pay tax on that, which is after your personal allowance. Another thing that they have for small businesses or employers of labor who you will need to negotiate salary with is the Canada Emergency Wage Subsidy, which meant that if their income dropped from 2019, while compared with 2020, they can claim a portion of that based on certain criteria to prevent further job losses as well. Claim those benefits from the government. Then what will benefit you as professionals mainly as well is the home office expenses for employees. A lot of people had to work from home in 2020 and even up till now. So if you work from home from March, when the lockdown started in late March of 2020, there are benefits that you can claim for working from home. Even prior to that, they really had something that you can claim your home office expenses. But because of COVID, like 90% of the population worked from home with the lockdowns and all that. So there are 2 ways of calculating that, which is the main thing you want to do, so that at least you can keep more of what you earned. What does that mean? It means that for every day or every month or every week that you work from home, there are 2 ways of calculating the amount of expenses you can claim. The simple way is to claim $2 per day, up to a maximum of $400, which you don't need any supporting document from other than a letter signed by your employer, and is the simplified way. But it depends on your earnings. If you make the 100,000 plus, then that will not be to your advantage. You definitely should be looking at the more detailed calculation method. What does that do for you? It means there are so many things you can claim, and especially if you are living by yourself, or if you are living in a place where you have enough room to claim an area as your home office. So if you are living in a 2-bedroom apartment, you can claim 1 room as your office. If it's 2-bedroom, looking at the living room and all that, you can claim up to 1/3 as your home office. And in that situation, there are so many factors. You can claim your rent, you can claim your bills, and in addition to the home office itself too, part of it you can claim for your internet, you can claim your phone bill, you can claim the eligible expenses. Let me go to that. You can claim for your electricity, water, heating, utilities. There are quite a few things you can claim, as you can see from the list. You can claim your office expenses, stationaries. Sometimes I'll tell people, if you can claim, if you're working from home for a long time and you bought toner, ink cartridge, pens, folders, 5 folders and things like that. Anything that you would normally use in an office. Why not if not? That's the time to stock up. Or this is the time, depends on when you need it, to stock up on those that you can claim from. And also, if you had to buy a computer, if your employers do not provide it, If you are on commission, then you can claim that. Because for salaried employees, generally the employers will provide. If you can prove that, oh, well, they didn't provide and you had to, then that's a different thing. As long as the employer signs the form for you that they allowed you to do it, you can claim it. That's the rule number one that you should remember. The employer has to sign that they are the one that asked you to, and you are allowed to claim it. You can claim the fax machine. There are so many things, and there are ways you can package it. So how will that help you? For every dollar that you are able to claim, it reduces your taxable income by that amount, which then in effect reduces the amount of tax you pay at the end. So say, for example, you made 100,000 and you can claim 20,000 as home office. You are way ahead because your taxable income now reduces to 80,000. Another thing is there are other things you can do as well apart from that. So let me go through a few things you cannot claim if you are self-employed. You are saying you cannot claim your capital cost allowance if you bought your house, which is like the capital cost allowance, the mortgage interest and all that. Those are capital things. You have to buy your house anyway. You have to live in a place anyway. So those are things you cannot claim. Then the mortgage payment. The government is not supposed to be paying your mortgage. So because they know it's a capital thing for you. It's part of your capital, your property that is appreciating and is cost of owning. And they will tax you on that later, if they need to. If it's a rental property or something like that you're claiming. And then another thing talking about that, the home office, it depends on where you are. If you are living in Toronto and you had to go and work in Quebec, for example, which is cheaper, expenses, you can choose to come back to Toronto so that you have more to claim, if the dollar figure is higher. So there are so many ways to go around that. Then your office equipment, like major ones, printer, fax machine, briefcase, you have to buy your briefcase anyway if you're going to work, so you won't be able to claim that. Your calculator, that are things that are not related to COVID. Don't forget we're talking COVID situation now. Then you wouldn't. There are things that you have to have anyway, must have to work. Then there is if you have a landline that has a monthly rate, and that's what I say to people, it's better. Your cell phone is easier to claim than your landline in your home because they know you've had that already. And that's for your alarms, smoke alarm and all that people have, intruder alarm and so forth. So you won't be able to claim that. Computer accessories, you're not. Some of these things though, you will still be able to claim if you are on commission or you are self-employed. Don't forget that. Then now to claim, that's why I said you have the two ways. You have the simplified method, which is the $2 per day for up to $400, or which is a flat rate. And that is if you worked from home more than 50% of the time. And that's when you can use that. Or you can use the calculation of the detailed method. There are so many ways you can do that. Basically, what I recommend to people is to get it done properly for you so that in the end, you get the best advantage and the minimal tax payable is what you'll be paying. Some people want to be penny wise, pound foolish. They want to do it themselves. If you do it yourself, if you're supposed to pay a tax of 10,000, for example, and you end up paying a tax of 15,000, will you not rather pay the $150, $200 that a tax specialist will charge you and earn an extra $4,850? They charge you $150, for example, as opposed to doing it yourself and getting only 10 instead of 15, paying nothing. It does not, make sense that way. So you can't be penny wise, pound foolish. Another thing as well is you'll be able to plan ahead to know that buying RRSP, some say, oh, I don't want to buy RRSP, especially, I'm sorry to use the word, Nigerians say, I'm not staying in this country, I don't want to stay in this country, or even if I'm staying in this country, I don't want to do tax RRSP, it's a wise thing to do, full stop. There is no if or buts about it, especially when you are an high income earner, and that's what you should be planning. As long as your income is more than the minimum personal allowance that the government gives, which is about 13,000, you need to now buy RRSP, because at any point in time, you want to bring your taxable income to as low as you can. Because Canada is one country that has a graduated tax system. The higher you earn, the more the tax you pay. at over 50, no, let's say if you are making about 150,000, 120 something, 130, you'll be paying about 50,000, 50% of that income in taxes. So it makes sense. If the government is now allowing you to buy RRSP of 27,000, it will drop your taxable income to less, so that you are now at a rate of paying maybe 47, 37, it drops slowly. So it's better you bring your taxable income to the lowest level. That is number one. Number two, all the things you can claim, like your tuition, you can claim that in terms of if you are still a student or you are going to school part-time. That's why some people choose to be forever students in school because they know the tax implication. Even taking a few courses can help you sometimes. You are improving yourself to get the 6 figures you are looking for, number one. Number two, you are using it to reduce your taxes. You are, you're investing in your future. So there's so many ways and things you can do. They are little, but it adds up a lot. And then when you have all those money to invest it wisely, and then you want to start thinking of investing it in TFSA, so that the income that you are making, the interest, the capital gain, the dividend on that money is not being taxable again. Because you get a T5, you get a T3, that will be taxable as well. So you have to plan your taxes very well based on your income. And if you are looking at your income, capital gain and dividend are taxed more favorably than interest income. So there are so many factors to consider. And especially if you are self-employed yourself, there are so many things you can write off. There are so many ways to do it. It's good to be wise from the beginning. Charitable donations will help you, and so many. If you have children, if you have a spouse, you can do income splitting. So there are so many things, but time will not permit us to go into details on every area that you need to look at. But basically, just remember, like I said, make sure your taxes are done very well so that you are not leaving anything on the table. You should get as much. You should get as much from your employer, you should get as much from Revenue Canada, CRA, so that you are the wiser, you are the better, and it will help you in creating your own wealth yourself, because you are not working for CRA. That's important. I hope that helps a bit. I would now like to leave time for questions. If you have any question for me, we can cover it. Thank you. Okay, so you have your room, you have your roommate. There is a living room. If you are working from your room, I will claim that. If your roommate is working from his or her room. If you have the living room, if that is where you're working, because I had a family that was living, a father, mother, and 2 boys in a 2-bedroom, they had to claim 1/4 of the square footage for each of them. So you could do that. So basically what you can do, they're just saying, what space are you using? But if it's a 2-bedroom, you can claim 1/3 because you are working from your bedroom. That's where your table is. That's where your desk is. So I will claim 1/3 for that. So what people do, if you are living in a house, even if there are 200 of them, most people will set up in the basement and say that's 1/3. So it's just the more, if you can substantiate it, that's all that is important. Received SERB, if that was the only income you received, don't forget SERB now changed to CRB, Canada Recovery Benefit. So if you receive SERB, it was only for a certain period between March and September, and that would be 14,000. If you had no other income for that year, and there are eligibility criteria for SERB too. You have to not be working, you have to be home because of COVID, actively looking for a job and all that, not just sitting down doing nothing. If it's only the 14,000, don't forget you have your personal throughout the year. Don't forget your personal allowance is 13,000 about, plus or minus. So with that, it means that you are paying little or no tax, but you have to report it because it's a T4A. And anything that has a slip, please, the government knows, so you have to file it with your tax. They have it because they have records, and anything that they send to you, especially for SERB, you have to report it. So it will be calculated, and you won't be. You hardly have to pay anything on that if it's just the SERB. If you receive the CRB as well, it depends on how much of the CRB you received. If you received the maximum, because it's 900 every 2 weeks, That's about 5,000. So that meant you have received 19,000 if you did not work in the first 3 months, January to March before the SERB started. Then you might have to pay a little bit of tax. Depends on what else you are claiming. If you have children and you're getting child benefits, so there are so many other factors that matters, but you have to claim it. But when you have a T-slip, please don't forget that the government has a copy. If it's from your employer, if it's from your bank, if it's from your investment or anything, the government has a copy, so you have to claim it. You have to put it on your tax return. If not, they'll come back and come after you because they have a copy and they haven't seen it. So you have to remember that. No, the only thing life insurance does, actually, I have a fellowship in insurance too, so I can tell you a bit. It doesn't add to claiming on taxes. What does it do? Two things. It depends on the life insurance. If an employer does life insurance for employees, then they can claim it as an expense. If an employee buys life insurance for themselves, it's a different thing entirely. If you buy a universal life insurance, it has the advantage of cash-free growth in the investment. You are putting in after-tax money. So if you are buying universal and you are overfunding, it's a way of dumping money too. So that will be after you have done your RRSP. I always tell my clients, after you have done your TFSA, another way could be universal life. And then, it's cheaper early and it's better later because the premium doesn't go up. That's another story. But if you buy a term, no advantage, no nothing. You are just providing for your family, for your children, for your spouse and all that. But what does it do? It just means if something happened, any mishap, your family will benefit. Or depends on which one you buy and the company as well. You have one that if you have a critical condition, they can give you up to 40%. Certain critical, like terminal, up to 40% of the amount of life insurance coverage. So it's a good thing. But it doesn't have that kind of tax advantage. You can't write it off, except you're an employee. Or if you have a business and two of you are partners and you have a buy and sell agreement and you decide to buy one on each other, then you can write the premium off. And it's only the premium you are writing off. But when you get the cash sum, the lump sum from the life insurance later, is 100%. That's the only thing you can guarantee in Canada that is tax-free, which is another tax planning tip that I'm giving you. If you buy 1 million, so you see someone that is a multi-millionaire, they'll buy 20 million life insurance because they know that's the only thing their family will get without paying tax, except for the primary residence, which is another one, which is the house you are living in, you and your spouse. Even if the house is shifting to the children later because you and your spouse are there, then it becomes taxable in their hands because they have lived, they are not living in the house anymore. They are not, husband and wife and all that. So life. What do you mean by foreign investment? You can be in Canada and investing abroad. So there are two different ways. Or the foreign investment that you are earning in that country. If it's a foreign investment, you're living in Canada and the investment is in England, for example, or even Nigeria or US. Now, what is happening is the governments of different countries, they are having tax treaties. So because of that, they can ask you to sign some forms. I just had a client call me yesterday, yesterday, complaining about how Barclays Bank is asking them to complete a form and provide their social insurance number. So, which, what is happening is, and even banks in Nigeria are asking Canadians to provide, their social insurance number, because now there are tax treaties among governments all around the world. What it means is that whether or not you repatriate, any interest you are earning, if they want to know, they can take it. We emigrated from Canada, from England as well, to Canada. And within the first 5 years, because we still have, investment in England, we had a letter from Revenue Canada saying we have to pay tax when we cash, one of our bonds in England, because they have a tax treaty. So whether or not you're repatriating money or not, you have to decide. But they can ask you to pay tax on it. It's not all the time that they know, and it's not all of them that they know. But especially when it's government to government, like the bonds we had in England was with the government. So the Canadian government has more access to that. And especially again between US and Canada, they have tax treaties, so they will know. So be careful, it depends on where it is. But with Nigeria, like I said, that is happening a lot more now. They're asking you to complete forms, so they can't. Whether you left the money there or you bring it back, it's a matter of what's the tax implication. if you are if you have just newly arrived in Canada, if you declare, there is a limit that you can have. They expect you to have some assets there because you grew up there, and that is not taxable when you are bringing it in within a time span, which is about 5 years if they have not changed the rules. So if you bring all your money in within the 5 years, it's not taxable. So there are so many, it's a complex case or issue. So if you want more information, you can book an appointment with me and I can explain it better. So it will be a one-on-one thing because each case is different. It depends on your situation.